The label here, algorithm hates the labels, so got to cover up the brands, That way we can get more people to join in on this video. You know what's happening, right? Okay, so, all right. In today's video, we're going to talk some more about the 2% inflation goal that does not exist. This is something that I think has completely confused the entire financial markets, the stock markets, the individual people out there, all the businesses, the CEOs. Everybody is confused about what it is that the Federal Reserve is searching for when it comes to their inflation goals or expectations that are coming out of the Fed itself. Now, this is something that we have talked about so many times on this channel. Like, it's something that I feel like I'm really starting to beat a dead horse on, because it seems every video that I'm doing, I'm talking about the same thing here, but it's not necessarily the same thing that I'm talking about. There is so many little tiny, aspects to it that you really do have to understand it from a lot of different angles. So the more I repeat it, the more I talk about it, the more that I think a lot of people are going to start picking it up, as far as what it is that is happening through the Federal Reserve and their interest rate setting policies to try and curb the inflationary scenario that we are experiencing. So first thing we have to understand, though, is that the Federal Reserve was looking for inflation. The problem that they were facing was an inflation expectation that was persistently too low rather than too high. Now, some of the problems that they were facing, I'm going to read this. This is coming from Michelle Bowman's speech that she gave, I don't know, a couple of months ago, I think, about a month ago. Let me see if I can get where are we at here? This was April 5th, 2024. Risks and uncertainty in monetary policy, current and past considerations. That's the title of this. Now, when I bring this down, where are we at? There we go. Now, in this speech, she had this to say. There was concern that the federal funds rate, the FOMC's key policy rate, was too close to the zero lower bound, and that this proximity could limit the committee's ability to respond effectively to adverse shocks by using the primary monetary policy tools of lowering the target rate of the Fed funds rate. Now, this isn't me saying this. This is Michelle Bowman saying that the lower bound of zero pretty much ended their monetary policy as we know it. The adjustment of interest rates was no longer an effective tool. That's what she says. The ability to respond effectively to an adverse shock by using our primary monetary policy tools of lowering the target rate for the Fed funds rate. That was the problem, right? More broadly, many central banks around the world were grappling with the prospect of structurally low interest rates due to a variety of factors, including demographic challenges and higher savings rates, lower potential output of productivity growth, and greater investor demand for safe assets like Treasury securities. So basically, it was driving the interest rates down. She goes on to say, another notable change, this is one of the changes, she talked about quite a bit of stuff, but when she goes into the changes about how the Federal Reserve deals with things, right? Another notable change to the strategy statement was the adoption of what some refer to as asymmetric flexible average inflation targeting, or temporary price level targeting. Specifically, the new statement noted that, quote, in order to anchor long-term inflation expectations at its 2% goal, the committee seeks to achieve inflation that averages 2% over time, and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Now, this was given just last month, this speech. There is no 2% goal. They are not achieving a 2% target. They are going to achieve a appropriate monetary policy, achieving inflation moderately above 2% for some time. But they don't say how long. This is the monetary policy coming from the Federal Reserve. It is very, very important to understand it from this fashion, because most of the articles I'm reading, almost everybody I see talking about what it is that the Federal Reserve is looking to do before they adjust interest rates is seeing inflation come down to a 2% target. That is not right. That is not the way the Federal Reserve is looking at adjusting interest rates, or even the attempt of adjusting interest rates by looking at the inflation running down to a 2% target. That is not the way they are doing it. They are going for a 2% average inflation rate over time, and they do not give any kind of formula for figuring out what this average inflation rate over time is. And now this comes from Powell, who said this: to prevent this out, okay, let me bring this back here a little bit. If inflation runs below 2% following economic downturns but never moves above 2% even when the economy is strong, then over time, inflation averages less than 2%. Households and businesses will come to expect this result, meaning that inflation expectations would tend to move lower. Oops, I just lost my power. Would tend to move lower over time. That's when he goes on to say that the inflation that they are going to achieve will not have any kind of mathematical formula to it. Right? So it really comes down to what is it that the Federal Reserve is looking for when it comes to their 2% inflation goal. Now, 2% inflation is not something that they are going to achieve because they have never achieved it in the history of their existence. Like, they've had a 2% target since 2012 and never achieved a 2%. Like, there was times they hit it, but they were never able to maintain a 2%. So to believe that they are ever going to go for a 2% target into the future is really delusional to think about, because they have never been able to do it in the past. So now what they are going for is a 2% average inflation rate over time with no mathematical formula to figure out what the 2% average inflation is over time. Way they do it is to look for where in the past there has been a 2% inflation averaged. So now if you take the current inflation that we are experiencing today, which is elevated, and you start incorporating the inflation that we experienced over the last year, you would not find any time during the current moment in the last year where you would find a 2% average inflation. Inflation was running much too hot to even find a 2% average. If you go back 2 years, you still wouldn't find it. If you go back 3 years, you still wouldn't find a 2% average inflation. Take the current increase in inflation that we are experiencing today, and you incorporate all the inflation that we have experienced for the last 3 years, there is not a single moment in time in there in which you find an average of 2%. It was never there. There was no 2%. But if you start taking it back far enough and you go back to the pre-pandemic era, you're going to find that inflation was running persistently below 2%. But even if you incorporated all the inflation that we have had just recently and that little bit of disinflation or failure to achieve the 2% target prior to the pandemic, you would have to go back so far prior to the pandemic, all the way to 2008, before you would find an average inflation rate over time. This is what the Federal Reserve is looking at. They look back in time to see how far back, with all the lack of inflation that they had during the post-Great Financial Crisis era, how far back would they have to go in order to find a 2% inflation over time? Now, just recently, I can't remember I think it was out of the Boston Fed, they were talking about this very scenario, and that there is no mathematical formula, but you can find a 2% average over time if you go back far enough and find it in history. And now we can look and see where it is in the history of time that 2% average inflation existed. This is what the Federal Reserve is looking at. If they can keep inflation elevated, then that timeline will shrink up. How far back do they have to look to find a 2% average inflation? Eventually, it'll get to a point with all the current inflation that we are experiencing and all the shortfalls from inflation that we didn't achieve back during post-Great Financial Crisis. Eventually, there will come a moment in which that the timeline cannot get any closer to us. There is no moment in which that the inflation, as elevated as it is now, can bring the average inflation any closer to us before it starts moving up the timeline, or before it starts moving back up the inflation pressure side of things, up the percentage basis, being on that timeline. I know this is very difficult to understand, and not always do I explain it just right. But at that moment, the Federal Reserve can see it as a possibility to then start going into forward-looking average inflation. See, right now they're in backward-looking average inflation to see how far back in time they would have to go to find a 2% average inflation. But if they can bring that average inflation closer to the current timeline, eventually it'll meet an inflection point. Right? If that inflection point happens to coincide with a current inflation of 2%, like if for whatever reason the inflation scenario comes down and it hits 2% at the same time this inflection point makes it, it can't get any closer on the average inflation, the Fed could then switch to forward-looking average inflation and then conduct themselves from shortfalls within the inflationary scenario. So if inflation starts falling below 2%, they again can adjust the inflationary scenario to then bring the inflation back up to the 2%, and they can look at this in a forward-looking average inflation kind of timeline. So difficult to understand. I get it, right? Because most people want to look at the Federal Reserve and say, no, I want a mathematical formula. I want it to be spelled out very easily. 1 + 1 = 2. That's the way that most people want to get the information, but that is not the way the Federal Reserve is conducting it. All right? There is no 2% target. See, like another way to kind of understand this is that they have tried to do a 2% target. They really, really, really tried. In fact, central banks all over the world attempted to go for this 2% target. They thought that this was a good number. However they came up with that, I don't know. Some banker over in New Zealand thought it was a good idea and everybody agreed, right? But now here's the problem. Imagine that you're trying to shoot a rifle at a target, right? You got a bullseye over there. Now you're not aiming for the bullseye. What you're doing is you're aiming for just above the bullseye at a number of 2. All right, so you got the first ring, you got the second ring, you got the third ring around the bullseye. You're going for that second ring. All right, and so you go out there with your rifle and you pow and you take a shot, right? And it misses. It doesn't hit 2%. It hit just below, or it doesn't hit the number 2 ring. It falls just below that and hits the number 1 ring. In fact, it almost hit the bullseye, but you didn't. You hit the number 1 ring. That's okay. Try it again. Shoot for that number 2 ring, right? Try it again. Pow, you shoot. Doesn't hit it. Falls below. You hit the number 1 or maybe slightly above it. Hey, keep firing, right? Boom, you shoot again. Still not hitting that 2. You're still just below it. Now, you've done this a few times. You've never achieved hitting that 2, right? You've aimed for it a couple of times. You tried, but you can't hit that number 2 ring. And I say, okay, that's all right. Don't worry about it. What we're going to do is we're going to take one more shot, right? I want you to fire above the 2 enough to make all the shots that you have had into an average of 2%. Now you have all these shots that you have taken at this target. You have failed, right? You've gone below 2 on every shot that you have made, but now you got one shot that you have to hit to bring the average up to 2%. How high of a shot would you have to make? Pretty significant. Now, this is what we are facing within the economy. They tried for the 2% all throughout the great financial crisis for 10 years straight, all right? Going for that 2%, failing to achieve it. It ran under 2%. A couple of times it went above, but for the most part, it was below 2%. The average inflation rate had fallen below 2%. All the people of the markets and the labor force and consumering and all that other stuff had no fear of inflation in 2019. All right? Nobody cared. In fact, Donald Trump was out there screaming, there's no inflation. The Fed should be printing money. Germany's doing a good thing by going into negative interest rates. The Fed should be doing negative interest rates. This is all what Donald Trump was saying because of the lack of inflation that we were experiencing. Like, they were trying to get it. They were doing anything they could. Right? And that was the problem that was being faced by the Federal Reserve back in 2018. When you go and you read John Williams' speech, Monetary Policy for a Low Neutral Interest Rate World, I mean, he straight up says it right there in that speech, that the problem that they were facing today was an inflation expectation that was persistently too low rather than too high. and that monetary policy was always swimming upstream against a stream of an inflation expectation that was persistently too low rather than too high. Right? This was the problem that they were facing. And now, as we look at what it is that the Federal Reserve is trying to do, most people are looking at it saying, okay, well, at some point they're going to be adjusting these interest rates. That is not the effective tool anymore, right? We just went over a speech about this very thing, about the communication styles. We did it in a members-only live stream over the weekend. And I tell you, Jefferson did a great job with his speech talking about how it is that they use their words more than the actual adjustment of monetary policy. In fact, they said it in there that there something about their communications matter more. In fact, it's the only thing that matters, right? This is how important it is to the Federal Reserve and how it is that they are communicating out there. I mean, we have to think, like, there was a time that the Federal Reserve didn't say anything. Like, you would wake up one day and all of a sudden monetary policy had changed. And they didn't make any announcements. They didn't have any press conference. They didn't explain themselves. None of that stuff. You just woke up one day and the interest rates were different. And they were like, yeah, surprise the markets, right? In fact, they said monetary policy would have been more effective by surprising the markets. Right? This was back in the day before they had all these press conferences and stuff. Well, then they realized as they moved closer to the lower bound of zero, that monetary policy was coming to an end. They knew the adjustment of interest rates was not going to be the effective tool, and they knew it from a long, long time ago. I mean, Ben Bernanke was talking about it in a speech from 2002 and how deflation was more of the concern coming to the Federal Reserve and how to prevent it from ever taking place here. The things that he was describing within that speech on how to prevent deflation from occurring here in the United States are exactly the things that we are experiencing right now here in the United States. Right? The forward guidance, the jawboning, the credible threat, the words that they use is far more important than the actual changes to their monetary policy. This is how crazy and how different things are now within the central banking system comparatively to where they were even just a couple of years ago. Most people, I mean, and I'm talking like 99% of the people out there are stuck in the way that the Federal Reserve used to operate. The adjustment of Fed funds rates was the primary tool. They hardly even told people when they would do it because surprising people was more of an effective tool to the monetary policy back in the day. But that all has come to an end. It just doesn't work. In fact, they came up with communication tools to make the jawboning, forward guidance, credible threats more effective. Do you know one of those tools is the plot map, that dot plot? That same thing that was communicated to the markets at the end of the year that freaked everybody out and convinced them that there was going to be 7 interest rates cuts coming into 2024. Now we wonder if there's even going to be one. And that tool that they used was a tool of communication that was brought to the Federal Reserve so that they can continue on with their credible threats. It is a credible threat tool. That is a monetary policy tool, the plot map, that dot plot, which never existed before they realized, man, how do we communicate to the people more effectively? I got it. Maybe we could come up with this thing that we have an idea of where we would have interest rates based on the current conditions today. And they communicate that out to the people and don't really tell them that this is not our actual voting time. All right. This isn't what we're going to do. This isn't like a plan. This is simply an idea. It's a way to communicate to the people the idea of what it is that they feel is going to be coming to the economy based on the current situations. Right? And considering that the situation always changes. Like there is no way by the time that those interest rate cuts were going to be hitting the markets that we would be sitting in the same condition as we were at the end of last year. That was not a possibility. Right? So to believe that the interest rates were going to be in the positions in that those Fed governors had thought that they were going to be based on the information that they had at the time, I mean, it's complete illusion. It's like, it's making stuff up. It's literally making it up, because there's no way that you can sit there and say, well, the current market conditions that we are facing today are going to be exactly the same in 6 months. Like, no way. That's not even a possibility. It's like complete delusion. Yeah. All right, let's move on here. We got 20 minutes into this. I've really cut loose on this one today. All right, let's cruise all the way up to the top. Man, look at all these comments. Oh my gosh. Okay. Salutes and respects to the uneducated and the chat. Well, thank you so much, Long Beach Joe Jets. All right, ready, set, go. Glad to see you here, all-nighter. Do another stream with Owen, please. Yes, we'll get one planned up here soon. All right. Oh, hey, $4.99. We'll go check out that super chat here. Deja Vu says afternoons. All right. All-nighter says, hey, Deja. Okay, let's go check out that super chat. All right, City Star Productions. This hitting me up again, man, with the $4.99. Thank you so much. We are in a new age of monetary policy. The only thing to do is to learn and adapt. Yeah, that's exactly right. And this is where I really find, so people ask me all the time, what am I supposed to do with this information? This is it, man. Understand the information. Understand that what it is that we are talking about in this video right now, about how it is that the Federal Reserve uses their communication to try and conduct their monetary policy. And it's not even trying. This is working. This is working for them. Don't think about the adjustment of monetary policy as the interest rate adjustments. Look at monetary policy as the voices talking about interest rate adjustments. That's the monetary policy within itself. And if people believe it, or what it is that they are saying that people are internalizing from that information, do they believe that there is going to be interest rate hikes going into the future? If that is what the narrative believes, then the actual impact to the economy will have that same sort of effect as if the Fed had raised rates. So it's important. Look at the communications, literally stand back and not try to guess what it is that's happening out there. Read the articles. In this article, are they feeling hawkish or are they feeling dovish, right? How many of these governors are coming out talking in a hawkish form, right? They're not planning, they talk about adjusting interest rates within that talk, within that article. But it's not the adjustment of interest rates. It's the idea of what it is, right? So if you can see that, right now, if you go and you look at all these governors and all the Fed speak and all that other stuff, there ain't a single dub amongst them. They're all very hawkish. None of them are talking about interest rate cuts. They're all talking about hikes. 6 months ago, they were all talking about cuts. Nobody was talking about hikes, right? So those communications, that is the monetary policy, right? And it's so important to understand it, because most people look at those communications thinking, okay, this is the anticipation of the monetary policy. No, wrong. Monetary policy is being conducted at that moment, right? Not in the future, not what they're talking about. It's happening right then. And that's what's so it's so frustrating to try to explain it, because there's no, it's like I said, most people want it like a mathematical formula. 1 + 1 = 2. How hard is that to do, right? But that's not the way this is done. All right. The dollar is backed by inverse silver supply demand. All right. State of Wisconsin is buying Bitcoin. Interesting. Yes, policy is just a state of will with some talks, but it's not guarantee of the action it is meant to promote. That's right. And that's why, I don't, until you actually hear Jerome Powell say something, the FOMC is planning on doing an interest rate cut at the next meeting. That is not something that he has ever said. He always uses vague terms. We are likely done raising rates. Likely done raising rates. That's not a commitment, right? That is a most likely, but it's not a commitment. So therefore, he might as well not have said anything at all, except that the most likely being done had people convinced they're done, right? They took that as, we're done, they're done. Interest rates aren't going up after this. Committed to that outcome. No, they didn't. They didn't commit to that, right? So this is the communications that they have that the Federal Reserve is very concerned about. Like they realize, man, when we say something, they take it very seriously. And if you say likely done, they will take that as definitely done, even though that's not what they said, right? And this is the communication styles that they are like they are actually have models and like technical analysis being done right now, deciphering every single time that the Federal Reserve or Jerome Powell says something, how it is that the markets are reacting to that. Right? They're building models right now. I mean, this was talked about in Jefferson's speech. This is how they are planning on doing this going into the future, is to figure out what it is that they can say that will then guide the markets appropriately, because if they say the wrong things, the market will take it incorrectly, and they won't be able to conduct themselves the way that they were intending, right? So they're literally building models right now to know the psychological terms and words and phrases that they can use in order to guide the markets. This is scary. Like, this is literally the greatest psyops operation, like thrown right into our face. Like, just straight up, they're not even trying to hide it from us. Right? I mean, they're even, describing how they're doing it. And like, I don't know how many people are actually seeing it, All right. Hey, Johnny Midas, thank you so much for that $20, man. Right on. Thank you. I love hearing your viewpoints on the Fed economy. Please accept this fake fiat funny money in the spirit which it is intended. God bless. Well, thank you very much, Johnny Midas. I really appreciate you sending the 20 fiat fake dollars to me, because my family and I will make it into some great use, as you guys are always so awesome with the generous donations and benefiting the uneducated economist and helping me grow out of doing the 9-to-5er to becoming a full-time speaker, writing books, doing courses. I don't know what my future is, but I'm looking forward to it. It is not scary. No, it's not scary. PSYOP, psychological operation. That's right. Okay, hi UE. Do you think that the market crash of assets could still happen due to the fact that the interest rates were raised and how we had a recession multiple times when they started lowering rates? I think there's a good possibility that asset prices could come down in a lot of sectors out there. I think there's going to be buying opportunities, especially if the financial markets start to get really tight. Like, it starts becoming very difficult to borrow money and the liquidity issues start to rise, which I'm still anticipating coming, especially, with the Treasury still planning on doing all their bond buybacks and the Federal Reserve reducing the balance sheet runoff. I can only assume they're doing that because they foresee liquidity issues coming into the future. If that is to happen, I would assume that there would be buying opportunities to be there. In what? I couldn't tell you. Like, you're going to have to just be very vigilant on where it is that you are looking to place your money and, be able to take advantage when you see it happening. The only thing that has to be at that time is you have to take on the position of cash, which is very scary right now considering the inflationary scenario. And when you see things like the stock market running up as high as it is, and you see gold running up as high as it is, even Bitcoin running up like it is now, it makes you concerned about like whether or not you're actually going to see a buying opportunity going into the future. Just take it into consideration. Do you see a liquidity issue coming? Like, I mean, just ask yourself that question. Is there a liquidity issue coming? And if there is a liquidity issue coming, then that's going to bring asset prices down, as people are going to be selling those things off in order to cover their debts. It's just the scenario that's going to take place. Now, it very well could be that we do not run into a liquidity crisis and all we see is nothing but stock and gold and real estate and all that just continue to go up from here, and you should have put your money into those things. Yeah, that's a real possibility that could happen. And if that's the case, then you probably should be diversified, because most people are. I know I got money in the stock market. I got money in Bitcoin. I have money in gold. I have money in silver and real estate and all the other things out there, because nobody can tell the future. And if one of those things happens to crash, generally the other one is going to do fairly well. So being diversified is very important. being in cash, being in gold, being in stocks, being in real estate, being in all the stuff. Now, there's some days that you're going to want to be in it more than others, right? And that's, again, it's a matter of being vigilant. It's a matter of understanding what it is that you're looking for in your own life, where it is that you are positioned today. Are you 18 years old looking to create investments for the future, or are you 80 years old looking to retain the little bit of money that you have left for the rest of your life? Two very, very different positions that you're going to be in, but you're going to be looking at the same information as everybody else is, right? So, all right, moving on. I got 5 minutes left here, guys, and then I got to call it quits. All right, how long until the next bubble comes into being? I don't know. I think it's building up now. I mean, do you remember, like, it was a decade ago they were talking about the everything bubble, right? I mean, literally, like the everything bubble. And here we are still waiting for that everything bubble to pop. And it's not, like, it still hasn't happened yet. You guys want some sunflower seeds? All right. And I have no money. Well, that sucks. Oh man, do we live in interesting times. Yes, we do. Markets to stay irrational longer than you can stay liquid. Good luck. Yes, that is very true. And that's why, like, you know, it's good to be in a position in which that you can take advantage of the thing, right? Like, a lot of people are like, no, I want to take 100% advantage. Like, where do I put all 100% of my money? And I'm like, oh, I don't know. Jesus, you know, it's like, who could possibly answer that? I think it's deflating, but very slowly. They drag the debt ceiling forever. The land, hell, it's RV footprint of sand. All right. What do you see Bitcoin in 10 years? Oh man, I don't know. Like, my goal is to at some point own one Bitcoin. Now, considering that there is most of the Bitcoin has already been produced and is now out there, essentially what is available right now is all that will ever be available. Yeah, there's going to be some trickling in, but it's going to be fairly slow and not very abundant for the next 200 years or whatever it is, 150 years. So whatever's available right now is what's available. That's it. So get yours while you can, because the chances of you finding more availability of Bitcoin is very low, right? I mean, it's only, the network effect is only growing bigger with it. More people are trying to acquire it. Guys like me who want to get a hold of one are going to take out the available supply out there. So in my opinion, there is really very little room for Bitcoin to go down as much as it has the room to go up. Now, with that being said, Bitcoin is incredibly volatile. So I wouldn't be surprised to see it back down at $6,000 again, because that's kind of how Bitcoin operates, right? But then again, I also wouldn't be surprised to see it at $160,000, because that's the way Bitcoin operates. So I have very little faith or expectations when it comes to Bitcoin, but it is my, like, cryptocurrencies is by far my biggest position out of everything that I have diversified into. Cryptocurrencies is it. It's like the biggest one. And it wasn't my intent to be that way. It's just that's how fast and how big it's grown. So what does that say? Like, I didn't want it to be my biggest position, but it is. And it wasn't by intent to do it. It did it all on its own, right? Like it didn't do it on its own, but you guys kind of get what I'm saying. I wasn't expecting that to happen, and here it's taking place. So I'm not denying it. Like, it's something that's available out there. It's something that people should have, and I think everybody should put a little bit into their possession. But do I have any faith or expectations or desire from any of it? No, like none. Like literally none. I don't care. Like, if it went to zero tomorrow, I'd be like, well, figures. You know, I should have sold it. You know. I gotta go, guys. I gotta go back to work, but this was a lot of fun. I really enjoyed it. We got 275 people watching with 81 likes, $24.99 in super chats, because you guys are always so generous with those super chats and supporting the Uneducated Economist. Also, is that an old Yukon? It looks like in great condition. This is an old Explorer. It's a 99. It has 98,494 miles on it. And I don't think this back seat has been sit in but a couple of times by my kids. This is a very excellent vehicle. I'm so happy to have it. All right. Thanks, Simon. Bye. All righty, Ben. We'll see ya. The big cat has a big thumbs up. Have a great day, bro. Always insightful. Thank you so much for being here. All right. What Charger said? All right. What did Charger say? I got to go back and find it. Oh, I can't find it. All right. All right. All Nighter says, thanks, Simon, and everyone. Have a great day. All right. You guys as well, man. Thank you so much for being here. Uneducated Economist, you let me know.